Hello, in this lecture we'll continue on the test type problems, the smaller problems that could be in format of multiple choice questions. We have a company has fixed costs of $35,000, a contribution margin of 25%. If expected sales are $200,000, what is the margin of safety as a percentage of sales? So first we're going to think about, okay, what is the margin of safety? How can we calculate the margin of safety? We're going to put a colon there, we're going to calculate that. That's going to be the sales less minus the break even. So that's how we're going to calculate that. So do we have the material to do that? We have first the 200,000 is going to be the sales. The break even, we don't have that. So we're going to need that. That's something that we will need in order to calculate the margin of safety. And so that'll be our end calculation. So I'll put that, I'll indent that out there. And that is what we are looking for. Now, once we get that, then we need to get the percentage, and that will just be the margin of safety divided by the sales. That's how we're going to get margin of safety as a percentage of sales. So now we gotta figure out what the break even will be. How are we going to get the break even? The break even formula will be here. It's fixed cost over the contribution margin percent. So you can memorize that. You can kind of derive that. You probably want to have that somewhere handy for you when you're taking test questions. And that's going to then equal the fixed cost given to us up here being the 35. I'm going to put a comma, 1,000. I'm going to put Alt Enter to go underneath. And we're going to divide that by 25%, which is also given in the problem up here as the contribution margin ratio. I'm going to go ahead and underline that and hit enter, then go back on the cell, then we can center it. So that's our ratio that we need to do, our division problem. Therefore, then we can take this equals the 35,000, I'm just going to calculate this, divided by 0.25. 25% is 0.25, and that will give us the 140. So that's the break-even point, so 140. So we can plug that in here. That equals this 140 we just calculated right there. And therefore, the margin of safety equals, if we think we're going to get 200,000, we can say, well, how much over the break even where we make no profit are we? Minus the 140. Well, we have a 60,000 margin of safety. Well, what's the margin of safety as a percentage of sales then? Well, that's going to equal the 60,000 divided by the 200,000. So that's what a ratio is going to be. Now, it's not 0, of course, because that means that there's no decimals right here. So we're going to go to the Home tab, Numbers, and we can increase. It's going to be 30%. Or we can just hit this percentage, and there we have that. So 30%. So what is the margin of safety as a percentage of sales? Anytime you see as a percentage of sales, it's going to be that ratio. It's the 60 over the sales in this case. Next one says that during its most recent fiscal year, company had total sales of $3,260,000, contribution margin amount of $1,530,000, and pre-tax income of $445,000. What should have been reported as fixed costs in the company's contribution margin income statement for the year in question? All right, so we're going to do our calculation here. This is the kind of cost of volume calculation, and we're going to start off with the sales, just like we would with an income statement, which would be in this case, $3,260,000. But different than a standard income statement, we are going to subtract from that variable costs, and that will then give us the contribution margin. And we don't know the variable cost. They didn't give us that, but they did give us the contribution margin. So we know that the contribution margin happens to be $1,530,000, and they didn't ask us for variable costs, and we don't really need to figure it out, but we might as well because it's there. So we know that the formula for this would then be the $3,260,000 minus variable costs, kind of like our X, the unknown, and that should equal this $1,530,000. So then if we solve for the variable cost, we can see it's going to basically be a subtraction problem, right? So variable cost, then if we solve for this, is going to equal this 3,260 minus the 1,530,000, and that should be the variable cost. If you could see that right here, we can see it's a subtraction problem. Obviously, it's going to be the sales minus the contribution margin. And we could double check that by saying, okay, well, does that work? If I pull out the calculator here, does it work to say that 3260 minus 1730, and I know I left off 3 zeros, but same thing. Yeah, that works. Okay, so that's that one, and then we're going to say that we're going to take the fixed costs, which that's what we're looking for. We don't know that. And then we have the income before tax. It's kind of like net income. Net income before tax. So, and they gave us that number. So once again, we're backing into a number. They gave us the 450,000. So once again, we're backing into this number. So we subtracted these two to get to here. And now we're taking this minus this to get to here. We don't know what this is. And once again, that's going to be a subtraction problem. You can kind of see it's a subtraction problem by saying, well, if it's this minus this gets to that, then this must be the difference between this and that. If that's unclear, then write it down algebraically. We can say that it's 1,530,000 minus the 445. Oh, I'm sorry. Minus the fixed cost, the variable equals, put a space, the 4 equals the 445, comma. And then if you write it down this way, you can see algebraically that basically it's going to be a subtraction problem because we're going to subtract the 1,530,000 from each side. So the fixed cost then would equal the 445,000 minus the 1,530, and there we would have that. And then we'd have to flip the sign, of course. So we're going to flip the sign by saying negative of that. So I'll let you work the math on that, but you can see, of course, if we plug that in here, if we say this is going to equal this number minus this number, then that's it. And we can double check our work then by pulling out the calculator and saying, all right, does that work if we take the 1,530 minus the 1,085? That's going to give us the 445. So that works. So if there's only 3 numbers, you can probably plug something in there and then double check it if it's obviously it's a subtraction problem in this case. Next one says that a firm expects to sell 25,600 units of its product at $18 per unit. Pre-tax income is predicted to be $60,600. If the variable cost per unit are $9, the total fixed cost must be what? All right. So we can break this out and put what we know in here. Once again, we're going to take our sales minus our variable cost. That'll give us our contribution margin less the fixed cost. That's going to give us basically our net income before taxes. So on the sales side, we're going to start with sales, and we have firm expects to sell 20 units. So we have units that we're going to have, and then the cost per unit. So we'll have cost. So the units and the cost, and then we'll have the total, right? So we have to do this calculation here. So we got 25,600 units. They cost 18. I'm sorry, and this is cost, sales, or cost. It's going to be one or the other. We can go ahead and center those if we would like. Go on the home tab, go into the center, and we can make it bold. All right, so then we got this equals the 25,600 times 18. So they have 25,600 units times 18. That means we're going to have sales of 460,800. Variable cost. Remember, those change in relation to the number of sales. That's why we're breaking it out this way rather than a standard income statement, because we can do this kind of estimation this way. So we're going to say, okay, the variable cost for the 256 units is going to be $9 per unit. That's given to us here. Therefore, the variable costs are going to be the 25,600 times 9. That's the cost per unit. And there we have that. And then we're going to say minus, that's going to be the contribution margin. Contribution margin is going to equal the sales price minus the variable cost. And that's our contribution margin. So I'll put an underline there. And then what we do is we subtract out the fixed cost. So remember, there's only 2 types of costs we're kind of looking at here, breaking them out between variable and fixed. Fixed cost is the unknown. That's what we don't know. We're going to go ahead and underline that. What they gave us, once again, is they gave us the end number, which was to be income. So this is pre-tax income. So we're going to say income is going to be this minus this number, but we don't know that number, so we can't do that yet. And so, but they gave us that number. It's going to be 60,600. So we got to say, okay, this minus this is going to equal that. And obviously, again, that's going to be a subtraction problem. You can kind of see it. You can say, well, if this minus this is going to equal that, then I got to subtract. It's got to be the difference between this and that. You could write that down algebraically. 230, 400 minus something, which in this case is fixed cost, that's our unknown, equals the 60,600. So we can see it algebraically. We're solving for fixed cost, which means we're going to have to subtract this from each side, which will leave us with a negative, and then we'll have to remove the negative from each side. So I'm just going to do the subtraction problem and just say that fixed cost equals the, I'm going to do the 200, well, it would be something like this. We could say it's the negative, to flip the sign, of 60,600 minus the 230,400. So I took a couple steps in one. And there's a subtraction problem. So we can see it's a subtraction problem here basically. We're just going to say it's the 230,400 minus the 60,600. And there's no real problem to make an estimate if we're not totally sure, because we can just double check it. Say, well, does that work? 230,400 minus the 169,800. Does that equal 60,600? It does. Alright, so that looks like it's okay. Next one says, during March, firm expects its total sales to be 163,000, its total variable cost to be 95,300, and its total fixed cost to be 25,300. The contribution margin for March is, so this is going to be our same calculation. We're going to start with sales. How do we calculate contribution margin? We take the sales first, and that's going to be the 163. They gave us that number, less variable cost. And they actually gave us that number. It's 95,300, and that should give us the contribution margin, which is just going to be sales minus the variable cost. So all we have to do is basically know the formula that we've been using in order to do that, to get to the variable costs. Note that they gave us some extra information, which is going to leave us wondering that, when we do the problem, like, why do they give us that extra information? But that's what happens sometimes in the multiple choice questions. Next one says a company's product sells for $12.02 per unit and has a $5.03 per unit variable cost. The company's total fixed costs are $97,900. The break-even point in units is what? So notice was a key factor here is we're looking for the break-even in units. We've looked for the break-even in total sales dollars. In this case, we're going to calculate the break-even in units. How many units do we need to produce in order to break even? The way we're going to do that is we're going to take the contribution margin per unit and divide it into the fixed cost. So let's take a look at that and see if that makes sense. We're going to say, okay, the sales per unit is the 12.02, and the variable cost per unit is 5.03. I'm going to have to add some decimals here, obviously, so I'm just going to highlight this whole area where my calculations will be. I'm going to go to the home tab, going to go to the numbers, going to add some decimals, like so. Alright, so that means that we got the contribution margin per unit. So contribution margin per unit is going to be, we sell them all for $12.02, and they cost $5.03. Therefore, we're walking away after variable costs with $6.99 per unit that we sell. So now we can just figure out, well, how many units do we have to sell to like pay the fixed costs, to like basically pay the rent, the rent being one of the major fixed costs, right? The rent doesn't change month to month. So how many units after the variable cost do we have to pay to cover this? So in order to do that, we're going to take the fixed cost of $97,900 and divide it by the contribution margin per unit. I'm just going to say that equals this cell, which is this $6.99. We're going to divide those two out. So we're going to take the $97.9 divided by the $6.99. That means we're going to need to sell about 14,500. And obviously note that, it doesn't divide evenly. So that means that we're probably going to have to round up if we want to hit that break-even point. So it'll probably be 14,006. Now, if you wanted to see the dollar sales, you could multiply that times the sales price. In this case, if they asked for the dollar sales, which was 12.02 per unit. So this is how many units we need to make times the sales price, and we could then come up with the dollars. That would be this times the 12.02, then would be the sales in dollars. Next one says that a product sells for $260 per unit and its variable cost per unit are $189. The fixed costs are $432,000. If the firm wants to earn 38,020 pre-tax income, how many units must be sold? Okay, so this is going to be similar to the break-even in units, but now we're just going to add to it the amount of profit that we want to get. So first thing we need to do is get the contribution margin per unit. So what we're going to do is we're going to take the sales per unit, and that's going to be the 260. That's how much we sell our items for in this case. And then we're going to take the variable cost per unit, because those things change in a similar way, unlike fixed cost. And that's going to be our contribution margin per unit. So we're going to subtract that out. We're going to take the 260 minus the 189 contribution margin per unit. Now remember, in terms of the fixed cost, the break-even in units, we just took the fixed cost divided by this. That's how much money that we are walking away from after each unit sales. So it would make sense then to say, well, if the rent is whatever the rent is, then how many of those units do we got to pay in order to sell, in order to just basically pay the fixed costs that we know are going to happen. Now the only difference when we're projecting income is that we're going to take the fixed cost, which they gave us to be 432,000, and we're going to add to it the income that we want to earn. We want to earn pre-tax income. We're estimating 38,020. We had to add that 20 on there for some reason, so that's probably going to... All right, and then that means that if we add those up, then we're going to say this is going to be the 432 plus the 3820. This is the number then that we need to clear with our 71 units. So we need to say how many units do we need to sell in order for the 71 to add up to this 470,020, and that's going to be the contribution margin per unit. Here is the 71, and then we're just going to divide this out. So we're going to divide this out. We're going to say this equals the 470,020 divided by the 71 contribution margin per unit would mean that we would need to sell about 6,620 units. If we want to know how much dollar revenues would we need in order to make that 38,020 pre-tax net income, we can multiply times the sales price. We're going to sell those for 260, remember, up here. And that means that we would need revenue of 6,620 times the 260 of 1,721,200. Company's break-even point in units is 1,700. The sales price per unit is 12, and the variable cost per unit is 9. If the company sells 3,900 units, what is net income? So we're going to do our calculation for net income. We're going to have our three headers, though, are going to be the number of units that we have. Then we're going to have the sales price and the cost per unit. And then we're going to have the total over here. So this is going to be what we have. I'm going to make that bold. We can underline it. We can center it. And we got these sales. So the units that we're going to sell, they say that we're going to sell in our projection 3,900 units. And the sales price per unit, 12. So we're going to say the total then would equal the 3,900 times 12. And that would give us the 46.8. Then we've got the variable cost. This is how we calculate within this calculation. And we're going to say that the variable cost per units are 3,900 units again, and the variable costs are 9. Therefore, we're going to say this equals the 39 times the $9 cost per unit, and that will give us the total variable cost, 35,100. This gives us the contribution margin. So contribution margin again, 3,900 units, and we can get the contribution margin per unit. I'm going to go ahead and underline this, home tab, underline. Contribution margin per unit would equal the 12 minus the 9. So after each unit we sell, we walk away with $3. And we can calculate this one of two ways. We can say we want the 46.8 minus the 35.1, and that'll give us the 11.7. We also could have calculated by saying that we want the 3.9 times the 3, the contribution margin per unit, to get the 11.7. Now the next thing that we would need are the fixed costs. The fixed costs, that's what they don't know. They didn't give us the fixed costs. We don't know what the fixed costs are, and that would give us the ending number here, which is going to be net income. And net income we do not know as well. That's what we're looking for. So question, how can we back into this fixed cost? How can we get that number? Next calculation that they gave us that the break-even point is in units 1,700. So we can take a look at that calculation. How do we get the break-even calculation? The break-even calculation, you'll recall, is fixed cost. So fixed cost, and that's going to be divided by the contribution margin. So the contribution margin per unit, let's say, per unit. So we know what that number is. That's 3. And we know that the break-even point is, in units, 1.7. So here we have it. We're looking for this fixed cost. That's what we're looking for. And we know that it's going to be this divided by that is 1.7. This divided by that is 1.7. Therefore, if it's a division to get to here, it's probably multiplication to get back to there. We can verify that by saying, well, it's going to be fixed cost is going to be divided by 3 has got to equal the 1.7. That's our formula. And therefore, to solve for fixed cost, if it's division, we have to do the opposite. We got to multiply, so it would be fixed cost is going to equal the 3 times 1.7. So do that again, equals 3 times 1.7, and that gives us our 5.1. So let's do that one more time. It's a division to get from here to here, so it's probably multiplication, which is going to be 3 times 1.7. And there's no real risk in us doing that because we can always just check our work. We can say, well, does that work? Let's see, if I took the 5.1 divided by 3, then we get the 1.7. So that looks to be correct. That now is our fixed cost. So now we had to find the fixed cost. So that's going to be the 5.1. And now we can finally get to our net income, which is going to be where we were before, the contribution margin of 11.7 minus the 5.1. So that one is a little tricky to back into a few things there.